Hello, in this lecture we will continue on Chapter 18, starting with the schedule of cost of goods manufactured. So before we go forward with the cost of goods manufactured, I want to take one quick step back to the cost of goods sold because the two are related. So you remember we have the cost of goods sold calculation in a merchandising and a manufacturing company being very similar. We start off with the beginning balance in finished goods for manufacturing versus the beginning balance inventory for merchandising, because the manufacturing company, remember, has three pieces of inventory. They got the raw materials, they got the work in process. We are concentrating in the cost of goods sold calculation, the cost of the goods that we are selling to the end user on the finished goods in this calculation. Then we have the cost of goods manufactured. That is equivalent to the merchandise that would be purchased in a company that just buys inventory and then sells it. Cost of goods manufactured is what we will concentrate on in this series. We're going to try to calculate that cost of goods manufactured, which of course is the new step that we must do if we manufacture versus if we just buy and then sell. That would give us the cost available to sell, the goods that we would have had available to sell. If we then subtract the cost of goods that are still in finished goods, then that will give us the cost of goods sold. So now to get to this calculation, we are now going to look at how to calculate the cost of goods manufactured. We're going to have a similar formula as that cost of goods sold formula. So the idea of taking the beginning balances plus what we added to it, whether it be purchases or something that we created, giving us what is available minus the ending inventory, giving us what we used, that type of formula will be prevalent many times. So it's good to get a good idea of that. We see that again here when we're looking at the basic formula for the cost of goods manufactured. And instead of having the beginning balance up top, as we did in the cost of goods sold, it's the same thing, but we're going to put the beginning balance down here. So we're going to start with what happened throughout the time period. And when we talk about when we make inventory, when we actually produce the inventory, what goes into the production of inventory? Direct materials. Obviously, if we're talking about guitars, the wood that goes into the guitars is in there. But we have to be aware that, of course, the labor is in there and the overhead. And these are things when we think about the service companies that we used to expense if they were in a service company most of the time. Many of these things, such as wages, that's going to be payroll for the people that work on the inventory. Factory overhead could include things like depreciation and miscellaneous tools, small tools, glue on the guitar that we don't want to have to track directly to each individual guitar. That will give us the total manufacturing cost. That's what we did throughout the time period. Then we're going to add to it what was in there at the beginning. So same type of calculation. That would give us the amount available. Then we're going to count what is still in work in process. Remember, we're talking about the work in process at this point. That will give us the cost of goods manufactured, meaning the stuff that went out of the processing department. If we're making guitars, it went out of the warehouse or wherever we make the guitars at, the production area, the factory, and then it's going to go to finished goods, the store, and be ready for sale. So the statement will look like this. Once again, we're calculating the bottom line, the cost of goods sold. This looks like a very intimidating statement, but if we break it down, then it's not so bad. So we're going to talk about the schedule of cost of goods manufactured. We want to think about it line item by line item. And when we think about this formula, again, we're thinking about inventory, and the manufacturing process has a few pieces to it that are familiar to us, meaning we're going to have to first calculate what's the cost of the materials, what's the cost of the labor, what's the cost of the overhead. Those are the things that are part of inventory. So we'll start with the direct materials. That's what most people are going to think when they think of something, right? If you think of a guitar, you think of the wood that goes into it. So we're going to do a similar calculation that we've just seen for cost of goods sold, and the entire cost of manufacturing is going to have a similar formula. So we're going to start with the beginning inventory, which in this case is the inventory as of 12/31/14, or you can think of it as January 1st, 2015. And that's because the ending period that we're talking about is December 31st, 2015. So we got the beginning inventory and the raw materials, then we have what we purchased, just like if we were selling inventory and we just bought and sold inventory. We know what we purchased in terms of wood if we're buying guitar, and that would, if we're making guitars from wood, and that would give us the raw materials available to use. Then we're going to count the raw materials that is still in the warehouse. It hasn't been shipped or hasn't been moved to the production process. The dollar value for that is $9,000 here. Therefore, this is the amount of wood we could have used. This is the amount of wood that is not in process in using or has been used yet. Therefore, the direct materials used then, the stuff that went out from the raw materials to the work in process and then eventually is going to go to finished goods, if it has not yet already, is the 85.5. Then we're going to take a look at the labor. Labor in this worksheet, really easy, because all we're doing is paying the payroll to the people who work directly on the guitars, and whatever they earn, instead of expensing it as wages expense, we are capitalizing it, meaning we're putting it into the asset, that asset being inventory. So in our schedule of cost of goods manufactured, the schedule of the stuff that goes into the inventory, we're just going to put those salaries, those wages, wages into this section. That's why it's over here on the outer column. So note that we're always going to calculate in one column at a time. So we're calculating this column for direct materials, summing it up over here. We don't need to pull direct materials inside at all. We're just going to put that one number out here because it only has one item in the calculation. Then if we take a look at the factory overhead, we have a lot of things in factory overhead, but as long as we determine that it should be in the factory overhead, then it's pretty easy to put it there. So things like indirect material, meaning, or indirect labor, meaning the supervisor's labor, or maybe the janitor's labor that's in the factory. Anything that's in the factory where we make stuff, such as guitars, that should go in here somewhere. If we can't apply it to a particular guitar, then it's probably going to go into overhead. Supervisor's salary, utilities. Again, the utilities is part of the cost of the guitar, but we don't know which guitar to apply it to very easily, so we have to put it into this bucket. Repairs on the factory, property taxes on the factory. Again, if it's not on the factory and it's on the administrative office, then it would be a period cost and we'd expense it as we have in a service company. But if it's on the factory, then it would be here. Factory supplies, factory insurance, notice the keyword factory. Depreciation on small tools, factory equipment depreciation, factory building depreciation. Again, keyword being factory. And notice this one, they actually put the word expense in it, even though we're not actually expensing it. It's depreciation that's going into the asset of overhead that will be part of inventory. We're actually capitalizing this. Same as amortization of patents. And then we're going to, of course, sum all that up here. And then notice now we're in the final column on this side. And once again, we're only going to do things to one column at a time. There's nothing above this 175.5, which is the total manufacturing cost. The next column over is, of course, these three numbers. What are those three numbers? Direct material, direct labor, factory overhead. Those are the numbers that are part of the total manufacturing costs. They are the numbers that are part of inventory. Direct material, direct labor, factory overhead is what is inventory in a manufacturing process. Then we're going to add to that, similar formula as we saw up here, the beginning balance. We're going to add to that what we had in there before. So this is what we put in there throughout this time period, this year in this case. This is what we had in there in work in process at the beginning. This then is what we had available. And if we subtract what we still have in there as of the end of the period, so this is what we had in there at the end, December 31st, 2015, versus what we had in there at the beginning, December 31st, 2014, that will give us what we have then transferred, finished, and put into the finished goods. So that's the cost of goods that have been manufactured. So if we look at the relationship between our statements now, here's our new statement, the schedule of costs of goods manufactured, and here's direct materials, direct labor, overhead, part of inventory. Those are the three items. Then the beginning and the work in process and the ending. Cost of goods manufactured is on the income statement. And the income statement, remember, for a service company was just income minus expenses. When we sell inventory, then we want to add a subtotal of our most important expense, that expense being cost of goods sold. If we add the calculation of that expense into the income statement, we would have the beginning inventory plus the cost of goods manufactured in this case, minus the ending inventory gives us the cost of goods sold. Obviously, the cost of goods manufactured is what is included in that calculation. If we were just purchasing inventory, that would be purchases. And then, of course, we have the sales minus the cost of the things we sell. If they're guitars in this case, that would be that. And that will give us the gross profit. Then we're going to work down to net income towards the end. Then on the balance sheet, what we have are our three inventory accounts: raw material, work in process, finished goods. We've been concentrated in here on raw material and finished goods, the transfer of raw material to finished goods, and the finished goods being part of the calculation of cost of goods sold on the income statement. So those are the relationships between the three statements. So now we're going to look at trends in managerial accounting. So we've got the customer orientation, the global economy. So clearly we're becoming more of a global economy. What that means is there's going to be more markets that are involved, there's more free trade involved, and it's easier to trade. So globalization means we're more connected. Many reasons on being more connected. One is just the contact that we have and the ease and the ability for us to be in communication. So certain things that will happen when that is the case, we become more of a service economy oftentimes if that's the case, because there's more competition and things are becoming easier to do and more connected. Therefore, people are demanding more customer service. Service is becoming more and more important, especially in the U.S., because many of the areas that we are really good at, being technology oftentimes and service type areas, movies and these types of things, entertainment, are service areas. So for America especially, service orientation is a big part of it. Customer orientation, same thing. As long as we get more and more connected, then customer orientation becomes more and more important. E-commerce, and that's going to have to do with the connectivity. And for the most part, that's a good thing, again, because we've had more connectivity, therefore we can usually produce more things. Again, with all these, there's going to be winners and losers, and we can think of the winners and the losers. We can think of things like bookstores that may have a lot of heavy competition with online books and things like that. But at the same time, if the bookstore can give a more customer-oriented environment, meaning they make it a location and things like that, then the bookstore can change and evolve to something bigger. We see similar types of activities with a comparison of, say, like a Blockbuster versus Netflix, whereas Blockbuster dominating the market in terms of picking up DVDs and not quite making the change to the globalization and the more customized and the e-service type of economy, when services such as a Redbox and the Netflix start to come into the picture, whereas they were positioned to do that, but didn't quite do that. So there's going to be winners and losers, but for the most part, this more connectivity, the more globalization, the ability to communicate more openly and have more markets that are available to us should allow us to make more stuff more efficiently, and overall that should be a good thing. Lean practices, we'll talk about that in the next slide. Value chain has to do with the amount of value being given throughout the value chain. And so we actually obviously have the raw materials. We're going to make those raw materials into an item that adds value to the raw materials. The labor, the overhead are adding value. But so is the distribution these days, which is also becoming very important as we're talking about here. The distribution, the sale, the way it's sold, how quick does it get to you. These are types of things that are part of the value chain that add value. And in line with that is the idea of a just-in-time system. And in that system, you're going to receive customer orders, schedule product, receive material just in time for the production, then complete parts just in time, and then complete production just in time and ship to customers. Now, it used to be that this would be a very kind of risky type of situation. We can take a company such as Dell Computers when they started to actually make the desktop as you order it. And it used to be that we would want to have some inventory on hand to be ready for making the computers or have pre-made computers ready. But if there's reliability in our system and we can order the computers very easily, very readily, and we're able to communicate with the customers very rapidly, then a system such as this, where we get the order and then we schedule the products, we get the material right when we have ordered it, then we get the parts, and then we ship it out, and we do it with very little inventory, then the inventory will not become obsolete in that case. We won't have to store as much inventory and have warehousing costs, and all those types of things will be trimmed down. Again, there's a risk to it because we could be in a situation where if there's any problem with that whole distribution line, then we're going to get held up, whereas if we had some stock, we would not. But again, as things become more efficient, this becomes a way to save a lot more time and a lot more money.